Hey everyone, and welcome. Today, we're diving into a huge question that a lot of Muslims have when they start looking at their finances. Can you actually invest in the stock market and stay true to your faith? Let's get into it and find some answers. Okay, so let's just jump right in and tackle the biggest question head on. A lot of people wonder, is the stock market just a big casino? Is it a form of gambling, which would make it haram or forbidden? It's a really important question, and the answer, as you'll see, is a bit more detailed than a simple yes or no. So to really get a handle on this, we're going to break it down into 5 key parts. We'll start with the basics, what Islam says about business in general, and we'll build all the way up to the practical side of things so you can actually get started with confidence. So first things first, let's just set the stage. What is the general view on commerce and making money in Islam? Is it something that's encouraged or something to be avoided? Well, the answer is pretty clear, and it's found right in the religion's core texts. You see, this verse from the Quran is actually a really powerful directive. It doesn't just say it's okay to do business. It actively encourages people to go out and seek their livelihood, to build wealth from the bounty of Allah. So right away, this sets up the idea that faith and finance aren't two separate worlds. They're meant to work together. Now, this is where things get really interesting. Islamic law makes a super important distinction between different kinds of financial activities. And understanding this difference, well, it's the key to the entire stock market question. So you've got some things like conventional banking that are considered inherently forbidden, or haram lavatihi. That's because their entire foundation is built on riba, which is interest. But the stock market, it's in a different category. At its core, it's just about buying and selling a piece of a business, which is perfectly fine. It's only conditionally permissible. And I love this analogy. It just explains the whole concept so perfectly. A goat is halal, right? You can eat it. But a stolen goat is haram. The goat itself didn't change, but the circumstances, the conditions around it did. The stock market is the goat. Its permissibility depends entirely on the conditions, on how you engage with it. All right, so if the stock market is the goat, let's talk about what makes it a stolen goat. We need to draw some clear red lines around the specific trading practices that Islamic scholars say are just not compliant. Okay, so here are the big ones. Futures and options are generally off limits. Why? Because they're seen as a form of pure speculation, almost like gambling on future prices, instead of actually investing in a company. Intraday trading is also a problem, because you're selling a stock before you even have full legal ownership of it. Short selling? That's out too, because you're selling something you don't even own. And finally, most regular mutual funds are a no-go, simply because they don't bother to screen for any of these rules and often invest in all sorts of non-compliant things. Okay, now we're getting to the real core of it all, the actual checklist, the filter you use to separate the halal stocks from the haram ones. This is where we take all that theory and put it into practice. But before we jump into the checklist, we need to understand this fascinating old-school principle. In Islam, you can't just trade money for more money. That would be interest. So for a company to be investable, it can't just be a pile of cash. It has to have real, tangible assets. This table shows the idea with an analogy of a gold-hilted sword. You can sell it for 102 grams of gold, even if the hilt only contains 100 grams. Why? Because the extra 2 grams are for the blade, the real asset, not for the gold itself. So, keeping that principle in mind, scholars have developed this really robust 3-step screening process. First, you look at what the company actually does. Second, you check its financial health. And third, you understand your responsibilities as a part owner. Step 1 is pretty straightforward. A company's main line of business just can't be in a forbidden industry. So that means no alcohol, no pork, no tobacco, and definitely no conventional finance like banks or insurance companies that are built on interest. It also rules out things like casinos or adult entertainment. Next up, we've got to dive into the numbers. Because even if a company has a totally halal business, it might still be involved in some financial practices that aren't okay. This step puts some hard limits on that. So the first big financial check is all about debt. The rule of thumb that most scholars use is that a company's total debt that charges interest has to be less than 33% of its total value. This number comes from an established Islamic principle where 1/3 is often seen as the limit for something to be considered excessive. The key thing here is that any interest-based debt has to be a clear minority of how the company is financed. It has to stay below that 1/3 line. And the second financial check looks at revenue. It's pretty common for big companies to earn a tiny bit of interest on cash they just have sitting in a bank account. This impure income has to be less than 5% of the company's total revenue. This chart makes it super clear, right? It's really about a principle of tolerance for what's kind of unavoidable in today's economy. As long as more than 95% of the company's revenue is clean, it can pass the test. But what do you do about that small, impure slice? Well, that leads us right into our final step.
This is a super important point. Being a halal investor is not a passive thing. You have responsibilities. First, you have to purify your profits. You calculate the tiny percentage that came from that impure income, and you donate that amount to charity. Second, as a part owner, you have a duty to use your shareholder vote to voice your opinion, to push the company to stop doing things like taking on interest-based debt.
Whew, okay. I know that was a lot of theory, a lot of numbers. It can feel like a bit much. So the big question is, how does a regular person actually use this checklist to make smart investment decisions in the real world? So really, you've got two main ways to go about this. The ideal path, if you've got the time and expertise, is to roll up your sleeves, dig into a company's financial reports, and do all the calculations yourself. But the much more practical path for most of us is to use technology, to use apps that are specifically designed to do all this heavy lifting for you. And look, thank goodness for technology, right? It makes all of this way, way easier. There are apps out there like Zoa, Islamically, and the Islamic Stock app that automate this whole screening process. They apply these scholarly rules to thousands of stocks and give you a simple, compliant, or non-compliant answer. They can even help you figure out that exact purification amount you need to donate. All right, so let's boil this all down. What are the key things to remember? 1, the stock market isn't automatically forbidden. It's all about how you do it. 2, you've got to steer clear of those definite no-go zones like futures and short selling. 3, you need to run every stock through that filter, checking both its business and its finances. And 4, remember that you have to be an active, responsible owner by purifying your earnings and using your voice for change. So, we really hope this whole explainer has given you a clear path forward. Some real confidence. The framework is there, the tools are out there, so now the question isn't really if you can invest anymore, but how you're going to start. The first step, well, that's up to you.